So why own your home? The two big arguments that I want to talk about first are forced savings and asset creation. So when we're talking about forced savings, what do we mean? Usually about 33% of your income goes towards wherever it is that you're living. So if you're paying rent, 33% of your income, if you're looking at a sort of a healthy financial portrait, 33% of your income goes towards your rent. If you're paying down a mortgage, the percentage goes up a little bit, so you're looking at between 33 and 50% of your income going to whatever your housing situation is when you're a property owner. What is that money doing? If you're a tenant and you're paying rent, basically that money is going to either maintain the building or to pay down the mortgage for the property owner. If you own your own place, what it's doing is slowly from the bank, you're buying back the building for yourself. So of your expense portrait, you're looking at between 33 and 50% of your expenses. Now don't forget, this is after-tax dollars. So let's say you earned $100, the government has taken between 20 and 50 of those dollars. Now you have 50 left. Of that $50 that you have left, 33 to 50%, so between, let's say, $17 and $25 of that is going towards your housing expense. Now, if you have a mortgage running, that becomes forced savings, which means that you are forced every month to put that money into sort of your own savings unit. Let's not say savings account because you don't have the cash available to you, but you're slowly buying back an asset that has that value. So that translates to forced savings. Now, when I talk about asset appreciation, what does that mean? So on the one hand, you have your mortgage with which you're slowly buying back your property. On the other hand, you have what that property is doing for you. So let me give you an example of a car. When you buy a car, let's say, I don't know, a nice expensive car, $50,000, when you sign your financing agreement with the bank, that asset is worth, or rather that liability on the first day is worth $50,000. You drive it off the lot, immediately it loses $10,000 of value. You drove it off the lot and now it's worth $40,000. When you're done paying off the loan on that car, let's say 5 years, 7 years from now, the value of that car is going to be next to zero. Maybe you'll be lucky if it's worth between $2,000 and $5,000. So over time, that good that you purchased has lost value. Every month, you're slowly buying back the car from the bank. That process is the same, but at the end of your financing period, that car is worth almost nothing. Now, with a real estate asset, that process is reversed. So let's say that today you purchase a condo for $100,000. There's no way that in 10 years that condo is worth $10,000. Also, your mortgage period is probably, if you take a standard mortgage, it's going to be 25 years. So in 25 years' time, when you've finished your financing period, that asset will have appreciated. So without you doing anything, that thing that you bought 10 years ago, 5 years ago, is going to be worth more when you come to the end of your loan than at the moment when you purchased it. So that's called appreciation. Very often people ask me, how can I be sure that there's not going to be market corrections? How can I be sure that my house or my condo is going to go up in value? Well, the answer to that is, in a horizon of 2 to 3 years, nobody can predict that. I don't have a crystal ball, and I can't say what's going on with interest rates. I can't tell you there's going to be this percentage of appreciation in the real estate market in the next 2 to 3 years. However, what I can tell you is that historically, when you look over 10-year periods, there is always appreciation. So the answer is, real estate is a bit of an illiquid asset, so you can't make projections on a 2 to 3 year time horizon. However, when you're looking at a 10-year period or even a 7-year period, the same amount of time on which you might finance a car, for sure there's going to be appreciation of that asset. So just to recap, when you get into home ownership, you're benefiting from two financial levers. The one is forced savings and the other is asset appreciation over time. So if we move on to look at the connection between debt, wealth, and home ownership, I wanted to talk about a study that's been done in the US. But first I'm going to talk a little bit about Quebec, and then I'm going to make a parallel. So Quebec is the most indebted province in Canada. We have the highest debt rate per capita, and interestingly, we also have the lowest percentage of home ownership. So in Quebec, 44% of households are renters, versus in Ontario, about 30% of households are renters. So why is this statistic something interesting? In the US, there were studies done on the African American community, And what these studies revealed is that basically over time there were certain policies put in place to prevent African American families from becoming homeowners. So, for example, white owners would be less likely to sell to African American families in an effort to keep neighborhoods white. Financing institutions would selectively not deliver loans to African Americans, and also in terms of approval for financing in African American communities, institutions were less likely to approve properties for financing that were already situated in African American communities. And so what the study revealed is that this low percentage of home ownership translated into a higher percentage of long-term debt. So what's the connection there? Well, basically you have to think that by doing forced savings and by using the lever of asset creation over time, you're developing basically a good that is, it's like there's a, how can I say, like a certain amount of capital that you can tap into should ever there be problems. So for example, in life you don't know what's going to happen. You can have an accident, you can get sick, you might find one of your family members to be dependent on you for whatever reason. And if you're a homeowner and you've built up the capital reserve in that property, this becomes then a sort of a cushion that you can dip into every time you find yourself in a financial strain situation. So rather than finding yourself in a situation of bankruptcy or having to go get a bank loan or do a debt consolidation, basically you can dip into that bank of capital that you've built on your property. And so just to come back to our study, well, it's, you know, one of the reasons that there is entrenched poverty in the African American community in the US is because they do not have this pool of capital that they can dip into should there be some kind of major event in their life that means that they need more money. And I believe that there's a little bit of this at work in Quebec at the moment with the low percentage of home ownership. And so if we want to start somehow turning that around, well, I think one of the things is that people need to put more emphasis on becoming homeowners themselves.